Hi folks, David Waring here again with InformedTrades.com and today's lesson of the day. In our last lesson we finished up our series on what traders look for when trying to determine the long-term direction of the US dollar. In today's lesson we're going to continue our free Forex trading course with a look at where traders go for information on economic releases that move the US dollar. So let's get started.
As you can probably imagine, we could spend many lessons and multiple hours going over each of the economic indicators that affect the price of the US dollar. It is for this reason that before getting into any of the actual indicators, I wanted to give everyone an overview of the broad things that move the market. As we've discussed in previous lessons, the two broad categories that pretty much everything that moves the Forex market fit into are trade flows and capital flows, as covered in Module 3 of this course. Once you have an understanding of this, all that is necessary to understand how economic numbers move the dollar is to understand which numbers are important to the market at the time, whether those numbers fit into the trade flows or capital flows category, and how they should affect the dollar as a result. As we learned in Module 8 of our Basics of Trading course, how the market reacts to economic releases is generally determined by two factors. Number one is how important the market considers a particular release to be. Number two is how close to market estimates the number comes in at. Remember that markets anticipate news, so generally, if an economic release comes out as expected, there is very little, if any, market reaction to that release. How important the market considers a particular economic release to be is something that changes over time depending on what is happening from a US dollar fundamentals standpoint. If there are worries that the US economy is going into recession, then the market is going to be extra sensitive to any numbers, such as non-farm payrolls and consumer spending, which may provide early warning signs that this is the case. Conversely, if the economy is heating up and the markets are worried that inflation may become a problem, then the most market-moving numbers may be price data releases, such as the CPI and the PPI. For your reference, according to dailyfx.com, the most market-moving indicators for 2007 in order of importance were non-farm payrolls, followed by FOMC releases, followed by retail sales, followed by ISM manufacturing, followed by inflation, followed by the producer price index, followed by the trade balance, followed by existing home sales, and finally foreign purchases of U.S. treasuries, or otherwise known as tick data. We've discussed most of these indicators already, and for those for which we have not, a quick Google search and a review of the indicator in the context of whether it fits into the trade flows or capital flows category should answer the question of why it moves the market. Although I'm probably a little biased since I used to work with the people who run the site, I'm a very big fan of dailyfx.com as the place where I go to find out what economic data is due for release and for commentary on the number after the release. They have a great global calendar, which you can find at the top of the site, as well as tons of both technical and fundamental commentary on everything that affects the US dollar and the Forex market in general. For this lesson specifically, if you click the calendar button at the top of the site, you'll see they have all the economic data releases from the major countries of the world with the time of the release, the previous number, the forecasted number, and the actual number, which is updated after the release. You will also notice here that they have links for the more important numbers, giving a definition of the number, its relative importance to the market, web addresses where you can find out more information, as well as the latest commentary on the number. If you click back to the home page, you'll see lots of FX-related reports which the Daily FX staff puts out throughout the day. Two of my favorite reports are the Daily Fundamental Report by Kathy Lean and the U.S. Open Market Points by Boris Schlossberg, which you can find in the middle of the page. As we discussed in Module 8 of our Basics of Trading course, the best way to get a feel for how economic numbers affect the market and which numbers are in focus is to start following the market on a daily basis and seeing how it reacts to various news events. As this is the case, I highly recommend following the commentary on dailyfx.com as well as the Forex commentary on informtrades.com and start putting your analysis to practice on your real-time demo accounts. If you've not done so already, I encourage you to register for a free real-time demo account, which will allow you to trade the market in real time with $50,000 in virtual cash. I've included a link above this video where you can do so if you've not done so already. That's our lesson for today, and that wraps up our discussion on the US dollar. In our next lesson, we're going to look at the next most traded currency in the world, the euro. So we hope to see you in that lesson. As always, if you have any questions or comments, please feel free to leave them in the comment section below. And good luck with your trading.